So it seems like Bloomberg Intelligence's Anurag Rana agrees. He's Bloomberg Intelligence Senior Technology Analyst. He joins us from Chicago. We heard from Thoma Bravo, Anurag, that public markets are not being discerning enough in the ongoing software sell-off. Do you agree that investors are just kind of throwing everything out or constantly saying no, no, no to various software plays?
Yeah, we wrote that note yesterday, and, I want him to go out and buy something rather than coming on TV and talking about it. So, I would say for the last 3 months, this has been our, discussion point that it's not that easy to get these systems out of the way. But every time I write something, next day the stock market again goes down 5 to 7%. So it's a difficult climate to be in software, to be very honest, right now.
Well, you argue that the ones who have market share right now, Microsoft, SAP, Workday, IT services firms like Accenture, they're going to benefit in the long run. How are they going to be able to use their market share leading positions right now to take more share rather than take a hit as a result of AI disruption?
Yeah, it's not that complicated. It's a very simple argument. Let me talk about Workday, for example. This is a company that has 65% of Fortune 500 companies' HR systems. And guess what they charge? Somewhere around less than $50 per user per month. You really think a company the size, which has 50,000 employees, 100,000 employees, will hire somebody internally to create an HR system or will go to a brand new entrant? But what are they going to save out of that? So, I understand software is a very profitable business, but sometimes when you look at the per unit cost of what it is costing an entire company, it's not that big of an amount. The bigger thing for a big, large enterprise or a corporation is how many headcount they have internally using people, taking care of IT services, help desk, and a lot of other things. And that's where we could see some compression. So I'm not buying this, large system of records, going out of business argument.
So, it's fair to say, though, that some companies might not be around in the future. So can you start to kind of separate the pack and say, yeah, these guys are going to be fine, these may not? Can you do that?
Yeah, I think our argument is when you look at companies that are large and cater to the larger enterprise, somewhat insulated. But imagine that tomorrow, whether it's OpenAI or whether it's Claude, comes up with a vertical specific software and then starts to go down market. Somebody that you're selling in small and medium businesses and, completely rip apart some of the smaller vendors out there. I think it can happen. But right now, when we are looking at everything in software being shot down. Let me give you an example right now. A company called Shopify reported today. They guided to next quarter revenue growth of over 30%, and consensus was in around 25. And guess what? Stock's down 12% at this point. So, but pre-market it was up, but given what is happening on the macro side, that's being sold off as well. So there are high quality companies like Shopify that are also put in the same bucket as some of the other smaller vendors out there.
What do you make, though, about what we've seen, and we just had up for those who are watching us on YouTube and on Bloomberg streaming, whether it's the financial firms like Charles Schwab and LPL Financial and Raymond James that took a hit. We continue to see them trade lower. Concerns about the ability of AI to generate reports and so on and so forth. Do those kind of companies have to be concerned?
See, I think basically what the argument right now is, if you were to Google right now, what are the top 20 intellectual, jobs out there that people have with master's degree, you can pretty much, make this argument for any one of them. It doesn't have to be just on the financial side. You can, we saw something on the insurance brokerage consulting side of it. You can make that argument for, R&D for a biotech firm for that matter. So, the argument is so strong that anytime you're looking at a human being with any intellect capacity, they are worthless out there in the future. And that's, I would personally take offense to that.
Yeah, and it's interesting. We've been showing shares of Dassault Systems, the ADRs that trade here, plunging by the most ever after issuing weak guidance. And there's some concerns that AI will disrupt its business model, and they play into automotive sectors and life sciences and so on and so forth. So the same thing. Is that an overreaction? What do you think?
See, in the case of the Dassault System, that's more the end markets that are weak. I wouldn't put that in the same bucket as AI disruption. It's just that they are selling their product into, into two end markets that are a bit weak. You have Europe being weak and automotive being weak. So, it doesn't matter. Whenever a stock is selling off, I think people love to write down it's because of AI disruption. And I don't think that's the case for that particular company.
Oh, interesting. Okay. If we've seen then some of the information technology stocks, some of the companies that do consulting, now wealth managers, some of the companies that do legal research, some financial services. What's left?
Yeah. So it's a very good point. And in fact, there is going to be certain disruption. Let's dissect, I think, the biggest company of them all, Accenture. I mean, I've covered this company for over 21 years, and it's one of the most phenomenal business models around because they rediscover their business several times. 20 years ago, it was a threat that, the offshore India-based companies will come and eat their lunch. Now, this is a company that has rediscovered or reinvented itself multiple times over. And right now, they are, putting a lot of emphasis on training their employees on Claude and OpenAI, and then going to their client base and says, well, let me help you evolve. Right now, what happens in a company like that is, let's say 95% of their revenue or bookings is coming from non-AI related stuff from the older technologies, but the 5% is coming from the newer ones. That mix shift will take a few years to change. And eventually, I think these guys will benefit from so much AI spending. Their employee base is going to change. We have never seen, the curve of revenue per employee go up at a faster pace than what we would see down the road. So there's a lot of things in flux, but I think somebody like Accenture will be okay in the long run.
I should point out Accenture shares, they are down more than 4% today, but I think there's either some insider selling or something. Great stuff. Great wrap up.
Check out his research on the Bloomberg Terminal.
And covered it all, right?
Yeah.
Because it kind of is hitting so many different sectors.
Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence out there in Chicago.